Investing with IBD is brought to you by AllianceBernstein, a global investment manager offering active, flexible solutions across asset classes. AB has the tools and expertise investors need to get their portfolios ready to navigate late-cycle investing. To find out more, visit abfunds.com. Okay, hello everybody. Welcome to Investing with IBD for May 29th, 2019. I'm your host, Arusha Pierce, and returning back to the studio once again is Chris Gessel, Chief Content Officer. Welcome back, Chris.
Well, thank you. I'm wondering why you're always having me here, but I appreciate it.
I'm wondering why you're always here.
All right.
On today's podcast, we're going to talk about the markets. We're going to talk about vertical violations, and this is a really interesting concept. And then we're going to end the podcast with another interview from our sponsor, AllianceBernstein, hosted by Randy Watts. And he's going to speak with Doug Peebles, Chief Investment Officer of Fixed Income at AllianceBernstein, about fixed income strategies. Okay, Chris, let's get into the market. Now, the market continues to be in correction, and now it's a good reminder that, hey, this is why we put markets in corrections. This is why we're careful in this type of environment, because sometimes it's easy to think, maybe this is a pullback. Maybe it's not that bad. Maybe I should still be on margin, and then you learn the hard way that these markets can turn around a lot quicker than you can imagine. So the environment continues to get worse. So it's important to play defense. You want to be careful of new buys because the trend's against you here. And of course, you want to let the market prove itself before really getting back in. And we're looking, of course, for a follow-through day to put us back into an uptrend.
Yeah, the thing, when the market's pulling back like this, we're in a correction, you definitely want to be raising some cash. You don't want to try to sit through one of these completely invested, especially not on margin. So, even it's really tough to sit with things that you have a lot of conviction if you've got too many other stocks and, everything is going down. So that's why it makes a lot of sense. If you're going to try to sit with one or two stocks, at least raise a lot of cash. So when they're moving against you, as almost everything was today,
yes,
you can survive and sit through it. Because the worst thing is to stay overly invested, take the losses, and then right at the bottom, then you sell, you capitulate, and then the market turns around without you.
And it's so easy to do that. It's amazing how well that works, or how easily I get caught into that. But you mentioned leading stocks. There are still a number of leading stocks that are hanging in there, but the list is getting a little bit more narrow.
It is getting narrower. I can tell, each weekend I go through my big watch list of all the stuff that I'm looking at for my own trading, for leaderboard, for swing trader. And it was about 130 stocks maybe a month ago. And now it's down into the 80s. And it's just because things have broken through the 50-day, through the 200-day. And it's like, okay, I'm not even going to look at this for a while. And quite honestly, I've kept a lot of things on that probably could go off. It could be even smaller at this point. So that's something to think about, because you look and you see Roku is making new highs, or was recently, and we've got a couple stocks. In fact, one we talked about that we're going to talk about later today, Anaplan, huge breakout yesterday. But then you also have to keep in mind all the other stocks that aren't working. And this is one thing from last year's Level 4 that Charles Harris said that really made an impression on me. And he said, I'm great at picking all the winners during a bear market. The problem is all the losers that wipe out those gains.
Yes, exactly.
So,
and Charles Harris is one of the portfolio managers here in-house, a longtime portfolio manager, longtime speaker at the Masters program too.
Very savvy guy. So I really took that to heart.
Yeah, and you have to learn it the hard way sometimes. I definitely learned it back in 2000, and so you take these environments very, very seriously. Now, I think this call for the market in correction a few weeks ago was pretty impressive, because honestly, I thought it was like, maybe it's a little too quick here. Right. Because there were a lot of leading stocks. I thought maybe we'd just keep it under pressure. But the more you explained it to me, and let's go over this, the reasoning why the markets team put it into a correction. And so let's go into that.
Okay. Well, we saw something that I've dubbed a vertical violation. And this I started noticing this over the last few years and doing research and then seeing it happen in the market. And then it was really about a year ago where Justin and I, in doing some market work, really kind of focused in this idea of how some corrections start, and they usually lead to a longer period of underperformance, 2 to 3 months, sometimes 20% or more, a few failed follow through. So it's a sign that you need to take notice of what's happening. And so really let's go back to October, because this is a great example. So on October 4th, the market had been kind of meandering around, not doing too much, and then it had a big sell-off, 1.8%. It was a big...
And this is on the NASDAQ.
This is on the NASDAQ, right. A big character change. So the market had been okay, and then, bam, it gets hit really hard.
Yep.
And then it continues to fall. And on that day, on October 4th, it took out the 50-day.
Yes.
And I think
three or four... higher volume.
Yeah.
Yep.
3 or 4 days later, it takes out the 200-day on a 4% sell-off. So when you get repeated days of selling and the 50 and or the 200-day is getting violated, getting really taken out, not just touched and then hanging around, but a clear breakthrough. And typically one of those days is really big. It hurts. That's what I call a vertical violation. And so we've seen a number of them in the last decade, and they started showing up maybe over the last 20 years. We've actually done some research lately, and starting back in 1955 on the S&P. And I think there was one during the 50s, and then really we went for like 15 years without seeing one.
Wow.
And so there may be something different in the market. Maybe it's indexing. Maybe it's just the volatility that change on a dime. But the idea is things are going well, and all of a sudden the market changes. You're taking out the moving averages. You're selling off day after day, not really getting any sort of rebound, and then that usually leads to a prolonged correction. We had one in February of last year, which that was a long period of correction that lasted until in April or so.
Right.
So fast forward to where we are in the market right now, and a couple of weeks ago, everything was seemingly pretty good, and then over the weekend, the news came out about the trade war being back on, and so the first couple days, the market sold off, came back, seeming okay, we're all right. Then I think it was after the market got support at the 50-day,
right?
couple days, the next Monday, the market sold off and it gapped below that 50-day, and that was the day when China retaliated with their own tariffs, and so that was a big sell-off in heavy volume, took out the 50-day, and so that, and given all the selling that we had seen previous to that, that convinced us that was a vertical violation, and that's why we turned the switch so quickly at that point. And I'll tell you that the following 3 days when the market came back, I'm like, well, this is one that's not going to work.
Exactly.
But then it rolled over, and we made new lows today again. Got support at the 200-day, bounced off of it a little bit. The put call was at 126, so that's pretty high.
Yep.
But is the put call enough to turn around a market that's worried about trade?
Yeah, that's true. Usually, no, if it's this kind of, but because sometimes it can go up like 1.4, it gets a little bit more ridiculous, right?
Right.
So you always need it. That's why they call them secondary indicators.
Exactly.
Right.
So for folks who aren't familiar with the put call ratio, it tracks the number of puts versus calls. So puts are bearish bets on the market, calls are bullish bets. Mm-hmm. Typically, you have a lot more calls than puts, and so the ratio is often under 1, or maybe it's right around 1 or something like that. But when the market starts selling off and fear runs rampant, you're going to see the number of puts go much higher than calls. And what we've found is when you hit a level of about 1.15. So there would be 115 puts for every 100 calls. That's where you can start seeing at least a short-term bottom. Today, it was at 1.26. That's been the highest since during the correction that we had in the fourth quarter. So we could see a rebound here, but it's, like you said, it's a secondary indicator. I would never hang my hat on it. It's just something to take in with everything else. And while we're on indicators, the Bulls Bears indicator, now it tightened up a little bit. That one is still a far way from crossing over. And again, to talk about what the Bulls Bears, again, a psychological indicator, it's the same idea. It's looking at bullish newsletter writers versus bearish newsletter writers. When they get very scared and they all think the market's going into correction or never coming back, that's usually when the market turns around. And really, the way I found it works best is when the number of bears is actually higher than the number of bulls, and that we're a long way from that happening.
Yeah, and we had that crossover back in December.
Yeah,
right. And that was the first time it crossed over in 2-3 years, since 2016, I think.
Mm-hmm. Yeah, so it doesn't happen often, but when it does happen, it can be very powerful.
So the gap down that you were talking about, below the 50 on heavier volume on the NASDAQ was on May 13th. So that was the critical day, and so that's when you guys put it into a correction. So we're in a clear downtrend right now. Now what we're looking for to put us back into an uptrend is a follow-through day. Right. And since we undercut the lows, we made a new low today. That count, when we start counting for the rally attempt, that's been reset back to zero.
We're at zero. We're starting fresh.
Exactly. So now we have the soonest we can get a follow-through day is 4 days.
See you next Thursday. Or no, Wednesday.
Exactly. Yes. Exactly. So that's what we're looking for now. We came close. There were a couple of times where it's like, oh, maybe, like I think a few days ago, it was like, oh, maybe we'll get it when the market started gapping up a little bit, but it faded very quickly.
Mm-hmm.
But I think the next critical thing is we're testing that 200-day too.
Right. And, the news right now is not great. One of the things we've been saying, I think, in past episodes, obviously trade is the big risk out there. And even if it gets resolved fairly soon, the question in my mind is, have the seeds already been sown for a recession? Now, Germany is right on the edge, and Europe, and it's not a good sign when Germany, which is typically Europe's strongest economy, is now the one that's teetering, and so that was some of the news that was pushing the market lower today, and then the yield curve inverted. I know you don't like looking at that kind of stuff.
Well, there we go. Because when we spoke about the yield curve maybe 2 months ago, right, then that was the concern there, and now it started to invert again.
Exactly.
So that's maybe I'm not necessarily looking at that as closely because I'm using distribution days or kind of classic analysis, but the rest of Wall Street's looking at it, and they're the ones who are going to create the distribution days.
And I know that some folks have said, well, that the U.S., our exposure to the rest of the world through trade is much lower than other countries because we have such a huge internal market. That's absolutely true. But just go back to 2011. I think that was the correction where it was just fears of a recession in China that caused that correction that lasted, again, that was a vertical violation, lasted about 3 months. There were multiple follow-through tries. I guess the one thing about this situation with this vertical violation and the correction that we're in, because it is a political dispute and it could be resolved at any time, although I don't think there are any talks.
Until June, right?
Yeah, well, at least right now.
Yeah.
So conceivably, it could be resolved at any time. And that's what makes it tough because you're beholden to the headlines, and it's rather than kind of the unfolding of the economy or the case in Q4, it was really earnings that was, or the lowering of earnings estimates that was pushing the market lower. So that makes things a little tougher. I would still, approach the first follow through day with a little caution, and it's not a sign to go 100% back in. You want to make a few buys. Don't bulldoze back into the market. Just see if it starts working. I think one thing to look for is if the market takes out the low of the follow through day, that's a sign to start cutting back. Maybe you don't get completely out, but that's never a good sign when you can't hold that initial strength.
Yep. So the market is still in a correction. We had a vertical violation that gave us the signal to put this market into a correction. Now, remember, even in the worst corrections, we are always 4 days away from a potential uptrend. So keep that watch list fresh, but play defense for now. So let's take a quick break. But when we return, we're going to talk about a few stocks that are resisting the downtrend and setting up in this tough market. So stay tuned. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We're back with Chris Gessel on Investing with IBD. Now let's talk about a few stocks that are bucking the trend and actually setting up in this tough environment. The first stock on our radar is Repligen, ticker symbol RGEN. And I was a bio major actually in college.
Right?
Yes. So when I read through this, I didn't help at all. No, but they're a bioprocess developer, and so what they do is they help these drug companies develop these large, complex molecules, and they're creating them within living organisms. Okay, and they're using organic materials, so it's not these simple kind of drugs anymore. It's getting much more complex, and these are used in cancer therapies and vaccines. So they're playing this really important role in helping these drug makers develop all these really complex molecules. Now, there are a lot of competitors in this field, and a lot of these guys are larger companies. But where Repligen differentiates itself from the bigger rivals is by selling technology that targets very specific pain points. And so it's kind of like IBD, right? We have a niche within the market.
Right.
They're doing the same thing. They have a niche and they're exploiting it, and they're doing really well. It's over a $3 billion company. And when you take a look at the chart, it's just been setting up. It had a really big jump back on April 26th. And it's just been consolidating this move. They got through earnings,
Right.
And they hit a new high today. They kind of pulled back at the end of the day, but they actually made a new high, and I think it's also maybe even an all-time high. Yeah, an all-time high.
Right, and it's in the the buy zone of this cup with kind of high handle. I'll just tell you, the way this stock got on my radar was looking at the Growth 250 on MarketSmith, but something I always do, especially during corrections, is check the list of stocks with RS lines at new high.
Yep.
And it's just amazing. It's like the quickest way to uncover what's doing well in an otherwise weak market, because the RS line compares a stock versus the S&P. And if the S&P is going down and the RS line is going up, you got something that's unusual.
Yeah, and just think about it. Pretty much all of my stocks today in the last few days have been going down. This stock is actually finished up.
Yeah.
It's up. And so it's just fighting that trend. And so if you think about it from a larger picture, you have all of these funds and all of these players in the market. They're lightening up, they're dumping shares, they're trying to move to cash as much as possible. But the ones who hold RGen, they're like, you know what? Let's hold on to this one.
Let's buy some.
Or let's buy some, right? Exactly. And so these guys are setting up. They have some pretty solid earnings. And yeah, a lot of times I like these companies that really target a specific niche, and they can exploit that niche really, really well because they develop that expertise within that realm, and all of a sudden the whole market wants to go and use their services.
Yeah, and in the earnings that we talked about last month, the big acceleration from 5% to 65% in the prior quarter, and sales accelerated from 25% to 35%. So that's exactly what you want to see. Really strong growth that's accelerating. The institutional investors, mutual funds and hedge funds, they are net buyers. There are more funds that are opening positions and adding to their positions than those that are closing them or reducing them. So that's a good sign. Again, this is when I'm keeping on my watch list. Maybe we'll put on leaderboard. I'm not going to touch it right now.
Yeah, we're in a correction.
Right. But I would really, pay attention to it. And if the market starts moving in the right direction, grab a few shares maybe.
And the industry group members of this group are pretty strong too. When I look on the weekly chart for MarketSmith, like there's Tandem is in there, CDNA is in there. So there are a number of other stocks here that are doing well. The medical products industry group, there's a lot of innovation obviously going on within this group. So let's go to the second stock, and this is Anaplan, and the ticker symbol is Plan, PLAN. They're a recent IPO, and what's new? Just like every other stock that's done well so far this year, they're a cloud-based software.
Sure.
And this is kind of the beauty of what's going on here, and I think it's a great lesson for everyone. Once the cloud all of a sudden became this really legitimate thing 5-6 years ago, and all of a sudden every company realized that, hey, let's stop hosting everything in-house, kind of like us, right? Let's start to use the cloud and become more efficient. A lot of these new companies that emerged, all they did was they just started to build better mousetraps, right? They just improved on one industry just a little bit better. They made it lower cost, and it was that much better service, and so they all started attracting all these customers who were stuck on an older kind of platform. So Anaplan's the same way, cloud-based software that helps with corporate planning. You want to talk about really specific? They're just focused on that. Now they call it connected planning, and so a lot of users within the company can go take a look at the software. They can adjust the metrics and see how that affects the bottom line of the company. So it's kind of cool. Like
we need to get this software.
Yeah, we might need to. Yeah. But in the end, this is the bottom line is they help companies make decisions quicker, right? And Chris, you're high up at IBD. You know how long it takes to make decisions around here, right?
Well,
like any company.
Sure, and once you make a decision, to keep everyone focused on it and actually get it done. And so, yeah. I'm going to check this out.
And so we might need to subscribe to it. But this is a company that they're allowing everyone to get on the same page and make those decisions better and faster. So a really, really interesting idea here. It's a new IPO. But like most IPOs, not profitable. That's true. But like a lot of these software stocks have done well, a lot of great sales.
Yeah, absolutely. And this is a stock that I traded earlier, and the reason was it was an IPO and it had great sales growth. In fact, I think it's had 40% or better sales growth for the last 13 quarters, even though it's only been trading since the third quarter. The fourth quarter. But this is a metric that comes up over and over, and maybe this is not a stock that you want to try to hold for a long-term gain, but the trading opportunities with these IPOs when they've got 40, 50, 60% or higher sales growth is been really, really good this year. So that's, I would definitely be interested in it. When I saw it breaking out on Tuesday, because the market's in correction and even my little tiny test trades have all gone against me. So I'm just not. I'm not touching anything right now. And I think what we saw yesterday, it was up huge. I don't know, like 15 or 20%.
Yeah, 18%. And actually had a breakaway gap on earnings. So they reported earnings. They had a breakaway gap. So a very, very powerful type of breakout. And even today, it came down. It was down 3.5%, but it still finished at the upper end of the range.
Mm-hmm.
It's acting pretty well considering the market.
Yeah, and it's at the top of the buy range. So, again, if you wanted to take a little test position,
pilot position,
we'll call it that. This would be actually a good place to do it, especially with the put call being so low. So high. So maybe we'll get a bounce over the next couple days. But I guess for me, before I go, serious into anything, I'd really like to see a strong follow through.
Yeah, but put the odds in your favor. Now, these guys, they're also in one of the best industry groups, actually the best industry group, number one, the computer software enterprise. And so the industry group members in this group you're going to recognize a lot of these guys: Shopify, Coupa, Twilio. They're all
Zscaler, Cyber.
Zscaler. Yeah, so they're not all fitting in the little snapshot of markets.
Oh, that's true.
So it's doing really well. Obviously, a lot of these stocks have done extremely well this year. But Anaplan is definitely one to keep on your watch list. And if we get whenever we get that follow through day, then this one you definitely want to take a look at. Let's go to the third stock here, and this is Insulate. And it's a diabetes company. Their ticker symbol is PODD, P-O-D-D. And they're an insulin pump maker. And now there are around 30 million people in the U.S. that have diabetes. Those are the people who have diagnosed. Right. There are a lot more people who are not diagnosed or at least have pre-diabetes. Probably all of us. Well, especially with all the donuts that are flying around here all the time.
Don't get me going on the poison.
Oh, that's true. Now, everyone except Chris, because Chris is a very, very healthy eater. But with Insulate, they have a wearable insulin pump called the Omnipod. So that's their big product. And it's an automated, it helps regulate the insulin for people. So it just makes it easier instead of having to prick your finger and check your blood sugar and all this stuff. All these innovations going on in the medical industry, it's just to make everyone's lives easier and to help people become healthier. Now, what's interesting with the market, this diabetes treatment market, in 2012, it was $245 billion. In 2017, $327 billion. So the market continues to increase as people get earlier and earlier diagnosis of diabetes. The market continues to increase, but I don't have this written down here, but I also want to, I read something else where in 2030, the global market, some of the predictions are like over $1 trillion, the addressable market for this. So these guys are kind of in this sweet spot. They have this product here that is in demand. It's a pure play within this, one of the few companies that is a pure play. And they're setting up, they're resisting the downtrend. And let's look at the chart here. They've formed a couple of handle. They broke out a few weeks ago. Currently 5% from the pivot. They can't pulled back in a little bit this week, but still on a relative basis, you want to look at these things, right? Market's coming in pretty hard. These guys are making new highs. They made a new high yesterday, an all-time new high, right? And so really great relative strength here, and something to keep on your radar.
Yeah, and the growth has been great. They're just turning profitable. They're a lot like Tandem.
Yes.
I think they're in the same market.
Group. Yep.
But we're showing losses, and then they're starting to turn profitable. And what's interesting is they're turning profitable from a very small base. So the estimate for 2019 is 520% growth. But 2020 is still very respectable at 168. So typically what happens is, you go from 1 cent to 5, and then you kind of stall. And it looks like this one is going to keep going. So, it's right at the buy point, or right at the top of the buy zone. The RS line looks good, like you said. Again, the big problem, the market.
Yes.
And I don't know. I mean, again, I would keep this on my watch list. I've tracked the stock over for a while, and I think that everything that we've been seeing, where the diabetes treatments are really changing. Everyone is embracing this idea of, the constant monitoring, the pumps that then deliver it. I think some are even trying to put the two together. That might be the next big thing. But unfortunately, there's a huge and growing market.
Except Chris, because Chris is into clean eating. Good for him.
Just no sugar, no refined carbs, or very few. But I think that this is like one of those big trends that we're going to see a number of stocks in the same way, like what you were talking about with the software stocks in the cloud.
Yes.
This is part of a big trend, and with the market, in your favor, this could be a big winner.
Yeah, and they went on a great run back in 2017 too, at middle of 2017 all the way through the middle of 2018. So that's another thing I noticed about this stock, character of the stock. Right, they've shown that they can go on a good trend when the market's good.
Right,
they reset also their base earlier last year when the market came in hard. So they undercut the low of a previous base. So it is a stage 1 base. So those are the type of bases that we want to look for, because you're shaking out a lot of people and kind of resetting the stock.
Yeah, and they're basically they're at a slightly higher price level, but basically the same area that they were a year ago. So you've had a year of sideways action, clearing people out, and now it's turning profitable. The one last thing I'll note is it's got some great sponsorship. Columbia Acorn and PrimeCap Odyssey are both holders, and I think PrimeCap has actually been adding to its position. But in general, we've got 249 funds that have added or opened position versus 187 that reduced or closed. So net, funds are buying this. They see that there's a lot of potential here.
So those are 3 stocks that are fighting the trend in this correction. Definitely keep it on your watch list, but remember, make sure that the market is back in an uptrend to improve your odds. Now, after the break, we're going to go to Randy Watts of William O'Neill & Company, and he's back with another sponsored interview. He's going to speak with Doug Peebles, Chief Investment Officer of Fixed Income at AllianceBernstein, about fixed income strategy. So stay tuned.
Hi there, and welcome back to Investing with IBD podcast. This is Randy Watts. I'm the Chief Investment Strategist for William O'Neill, and I'm joined this week by Doug Peebles, who is the Chief Investment Officer of Fixed Income for AllianceBernstein. Doug, thanks for joining us.
Pleasure to be here, Randy. Good morning to you.
What do you see for the U.S. Fed for the rest of the year and looking into 2020?
Yeah, that's a very good question. I think that the Fed is in the midst of changing their operating model, and I think what they're in the midst of changing that to is one in which they target 2% inflation. We know that that's the underlying driver. I would say that, for the last 10 years, they've also been very cautious to ensure that financial markets didn't fall out of bed. And I think that was warranted, certainly in 2009, 2010, maybe even into 11 and 12. But I just think that the whole Fed put thing has gone way, way, way too far. But nonetheless, and the change in policy is one in which, instead of targeting 2% inflation, they say we would like inflation to average 2% over time. And if you look at their measure, their favorite measure of inflation, which is the core PCE deflator, we've only touched 2% inflation twice over the last 10 years.
Right.
And so if you think about the actual inflation relative to the 2% target over time, there's a lot of catching up to do to average 2% over the last 10 years. And I think what the Fed has said is we would rather have a situation where if inflation gets to 2.5 or 2.6, but the cumulative inflation is still underneath the 2% per annum target, we're going to be comfortable with that. I think that whether or not that's a good idea, we can save for another time to talk about. But I think that at some point in time in the markets, we're going to sit and the market's going to say, well, our expectations for today's inflation print is 2.1 or 2.2, and it's going to come in at 2.4. And the next month, the market's going to be saying, well, we think it's going to correct back down to 2.2 from its 2.4 print, and instead we come out at 2.6. The market is going to look for the Fed to be tightening, and if the Fed is sitting there twiddling their thumbs when that happens, I think the yield curve is going to steepen a lot. And so in some respects, this whole notion of the changed policy is really not, the market hasn't bought into that. And so that's a view that we have that's quite a bit different than the market. I think that when Chair Powell came out in March and really started talking about this, and we know that Clarida and Williams are driving this bus. When Chair Powell came out and talked about this in March, the market took it like, wow, the Fed isn't doing anything on interest rates, right? Their dot plots, they're not going to hike rates for the next 2 years. And they've also stopped the reduction in balance sheet much earlier than the markets thought. The markets concluded they were worried about growth. And I think that that's the wrong worry. I don't think that they're overly concerned about U.S. growth. They might be concerned about Chinese and German growth, but I think that they're more actually starting to warm the markets up to their new thinking on inflation.
So I'd like to maybe hit a topic here and get your thoughts, which I think will be interesting to our listeners. The yield curve, the U.S. Treasury yield curve, has been very flat,
Right.
and there have been points in time over the last year where different sections have inverted.
Right.
There was a point in time where you had the 3-month to the 10-year invert, though that is actually not inverted right now. It's gone back to a normal positive slope. The 3-month to the 2-year remains inverted, and there's been inversion between the 2 and the 5 as well. So my first question is, what do you think? Well, really, two-part question. The first part is, what do you think of these inversions? Do they still matter? Is the yield curve still as predictive as it was before? And then after that, the second part, what do you see the U.S. yield curve doing over the next year?
Okay. So I'm a bit of a yield curve junkie. I think that there's a tremendous amount of information value associated with the changing slope of the yield curve. However, I do think that the information that the yield curve is opining on has changed somewhat, and I'll just summarize that, and I'll give you an interesting tidbit as it relates to that. I think that historically we've looked at the yield curve as a good predictor for U.S. Recessions, essentially, right? So when it inverts, you wait 12 to 24 months, and you're going to see a recession.
And the Fed, in fact, the San Francisco Fed wrote that paper last year, which I thought was funny, pointing out that the 3-month to the 10-year inversion has been a great predictor, and then they were actually able to get it.
Yeah, right, exactly. And so I think that remains important, but I think there's been a change in what the U.S. yield curve is opining on. I think that the global yield curves in aggregate are opining on the global economy. And so the tidbit that I was talking about 10 years ago, we changed our modeling efforts for yield curves around the world. We used to model each individual yield curve as its own, and then because it's really hard to predict which way rates are going, and it's a little bit less hard to predict which bond markets are going to outperform the other markets. So the notion of what we would do is say, look, if we think the Japanese yield curve looks attractive to the U.S. yield curve on our models, we're going to do the economic work to suggest, is that the right bet to make? And then, just go ahead and execute that in the portfolios. And we changed from that methodology to saying, let's look at the aggregate of the global yield curves as one yield curve, and then do a separate model that says, okay, where's the differential from that global yield curve relative to each individual country? That was a really smart move for whoever decided to do that. It wasn't me 10 years ago, because it's actually helped us a lot. I think that the sort of next iteration of that is, well, if there's a global yield curve, is that opining on the global economic situation? And when we talk about that opinion that it has on the global economic situation, I think it's a nominal growth rate, not necessarily a real growth rate.
Sure.
And what does that mean? I think that the impact on inflation and on real growth, so nominal together, is probably more important in today's world than it's ever been before.
So when you boil that all down, when you think about our yield curve, do you see it changing a great deal over the next year? Do you see it steepening or flattening or inverting from here? What are your thoughts on that?
I think once we get to the point when the market digests the notion that the Fed has changed their MO, that we will see a movement towards a steeper curve.
Which investors might interpret positively for two reasons.
I think it should be positive, right?
Right. They would think it might signal better growth, and it would also theoretically help financial companies achieve better returns because it's been tough on the net interest margin with the curve so flat.
Yeah, totally agree with that. And but I don't think, that little hypothetical that I gave you, that we got to print 2.2 and on the market's expecting a 2.2 print, we come out with a 2.4 print. I think we're still a ways away from actually getting that. So I think that the U.S. yield curve, when I think about it from just a pure U.S. standpoint, I would say that I think that the yield curve should be trend steepening over the next 3 years. But when I think about it in terms of the global economy, boy, it's hard to see that that the global growth outlook, while not like dramatically poor, two things. Trend growth is slower now than it's been in a long period of time. So lower levels of growth are going to be the norm. And the second thing is, I think that after several decades of free trade and open trade and some winners and some losers as it relates to that, I think we're in a different environment right now. We talk about populism in the election booth. There's also populism as it relates to policy emanating from, a situation where, from a textbook, open and free economic trade is wonderful. But from a practical situation, it leads its way into populist policies that probably aren't great for earnings and multiple expansion.
I guess it's a two-dimensional question. For U.S.-based investors, do you prefer right now U.S. fixed income or international fixed income? And then within that, do you prefer corporates or governments?
Yes is the answer. I mean, the first thing I should say is that for a bond investor, diversification is by far your best friend, right? We don't, if you buy Google's bonds, the best thing that can happen to them is they mature at par. Whereas you buy Google stock, it's like a crazy percentage increase. So diversification is good for bond people. So I like to diversify economic cycles, and I like to diversify monetary policy cycles and credit cycles. So for U.S.-based investors, we do think that the starting point should be a dollar hedged portfolio. But we do like to have the ability to buy different countries' yield curves. If, for example, the Fed is raising rates and the ECB is cutting rates, it's not all the time, but that's a pretty good head start in terms of the overall bond return. It might not be so good for the euro. And so starting with a hedged-based investment strategy, I think, is the smart thing. Now, you asked about credit as well. I think that one of the important levels of divergence that you get in a bond portfolio is to get the combination of interest rate cycles and credit cycles in a portfolio. And so what does that mean? If you look at the total return of treasuries and you look at the excess return of high-yield corporate bonds, those two data streams are inversely correlated, negatively correlated. And so what does that mean? It means that you can actually combine those two assets in one portfolio and both pay you over time. When you take interest rate risk and you buy a 10-year instead of cash, that extra interest rate risk that you take on pays you over time. Now, we talked about the yield curve being flat today, so it's not paying you a lot right now,
Right.
but over time it does pay you a healthy premium. And the same thing with credit. If you buy a double B rated corporate bond instead of the U.S. Treasury, yeah, the U.S. Treasury is not going to default. The double B rated corporate bond could default, and so you have to get paid an extra risk premium. But those two return streams are negatively correlated. So you get paid for both of them, and you combine them, and it gives you a free rebalancing when one outperforms and one underperforms. That, to me, is the best way for long-term investors to think about their bond exposure.
So being involved in both governments and in company debt credit. Do you have any thoughts on duration right now in terms of what you're telling your clients in terms of extending or shortening?
Yeah, I mean, I think that, first of all, people shouldn't be so afraid of duration. I think if I look at most financial advisors' portfolios, in the last 4 months, they've started to increase their duration because they think the Fed is done raising interest rates. The flip side of that coin is they're starting from a very, very low base, because when rates were zero and people thought the Fed was going to raise interest rates, the quick math in their head said a bear market in bonds, oh my gosh, we could lose a lot of money, don't have any duration in your portfolio. And I think that that's right if you're going to own 30-year zero coupon bonds, which have a 30-year duration. Yes, you
Right.
could lose a lot of money in that. But most typical bond mutual funds have around a 5-year duration. And it's hard over, a couple of years to have that give a negative return. Even last year. So the Fed did 4 interest rate increases last year. The Bloomberg Barclays Aggregate Index was positive. And so I think that the important part for the duration exposure is to say, in a world of searching for negatively correlated assets, and so much exposure that people have is in the equity market, do you have anything in your portfolio that's going to do well when the equity market does poorly?
Right.
And that's the real notion of duration. It's not so much that there's a lot of advisors who have their clients in 100% fixed income portfolios. Now, if that is the case, you would assume that that client is quite a bit older and living on a fixed income. Then you start to say, okay, what is their time horizon? If it's 4 years, then maybe your duration should be 4 years. And that's a pretty good mathematical approximation. But if your client is 50 and they're, in today's world, I'm talking my book here, but you could easily live to 100 and you got a 50-year time horizon, the bonds in your portfolio should really be an offset to the volatility associated with your risky assets. And I don't think that you should be concerned if your duration is 5 or 6 years in that portfolio. In fact, I think that the notion of being in cash, because it doesn't pay very much relative, it pays almost the same relative to the 10-year bond, takes away that offset, because cash doesn't change in price. Whereas, if I'm all the things that I said about the U.S. economy are wrong, and all the things that you said about earnings are wrong, and the stock market goes down by 25%, the 10-year today yields 2.5%. It's going to 175,
Right.
and you're going to want something in your portfolio that does well when the risky assets do poorly. And at the same time, if we're right about the economy and you're right about earnings, and all of a sudden you get a 10% return in the stock market, yeah, I think you're probably going to get a 1% return in bonds. But that's okay, because in aggregate, it gives you a better trade-off that both protects some of the downside, gives you the rebalancing alpha that you can get. So, yeah, I mean, if you ask me, do I think rates are going to be at 2.25 or 2 and 3/4 in the next 6 months? I'd probably say 2 3/4. But the notion of making a big bet on that, first of all, the information ratio on my success rate, or anybody's success rate in getting that thing right, is low. And it's not so much what you think. Like, when people say, where do you think that the 10 years going? I'll give them. And they're like, well, what sort of probability? How about 52-48? But then I say, tell me where the stock market goes. You tell me what the stock market return is, then I'm going to have a much higher probability that I'm going to be right about what I say about where the bond market goes. And to me, that's the most important thing about duration. Do the math. I would advise everybody to sit there and say, where do you actually think interest rates are going? Put it into a bond calculator and see what the total return is if you're right. I think that 9 out of 10 people who did that would be surprised at how good the return still is, because so much of it, if you do that calculation over the next 6 weeks, yeah, the price movement is going to dominate. But if you do it over 3 years, the coupon dominates. And I think that is what people should do. Do that math. Don't just in your market say, well, bear market, oh my gosh, 2008, the stock market's down 55%. That means that I could lose that much in my bonds. Maybe in high yield you can lose that much, but it's really hard to lose that much in a 5-year treasury.
And given what risk assets have done, maybe it makes sense to extend your duration a little bit as an anchor to windward.
Again, I think relative to where people are positioned, if I could just give a blanket recommendation is, extend your duration a little bit.
Thanks again, Doug, for sharing your thoughts with our listeners. Again, this is Randy Watts. I'm the Chief Investment Strategist of William O'Neill, and my guest today was Doug Peebles, who's the Chief Investment Officer of Fixed Income at AllianceBernstein. Thanks again, Doug.
Thank you, Randy.
Okay, thanks, Chris, for joining us on this episode. It's great to have you again in the studio.
Well, I hope to be back.
I'm sure you will. That's it for this week on Investing with IBD. Now, next week, we're going to have our good friend Justin Nielsen on, and he's going to talk about how swing trading is a great way to stay on the right side of the market and how you can also use this for your longer-term trades as well. I'm Arusha Pierce, and thanks for listening. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.